All right. Good morning, JP.
Good morning, Brandon.
So today we're doing our video, and you know what we're talking about?
Yes, I think. It's
Yes.
long-term investing.
I know. So you have the topic.
Yes.
I have to throw you a curveball.
Yes, you do.
Andrew's going to interview you. Andrew, come in here. Our new conscious wealth manager.
Okay. This is why you talk
microphone.
separately. Got it.
Good morning, JP.
Good morning, Andrew. Welcome aboard.
Isn't that how these things usually start?
That's always how they start. I'll help you at the end, though. What's going on? What are we interviewing me about?
Long-term investing
Yes.
is what we're talking about today.
Okay.
So, I mean, the first thing that we should all cover is what is long-term investing? What is the time frame of long-term investing?
Yeah, typically when we recommend to people, okay, I have cash, I want to invest in the market. What do I do with it? We typically like to say, if you don't need the money for at least 2 years, it's an investment, right? So we like to think of anything inside of 1 year that could be like a short-term gain or loss would be considered a trade. And then anything beyond that would be considered investing for practical terms.
Yeah. I think that time frame makes sense. That's also, I mean, how does that relate to like the tax situation around it? So that's similar too. Yeah.
Yeah. So if you were to buy a stock A and it goes up 10%, you sell it, right away within a month, 6 months, really inside of 1 year, you get taxed with short-term gains, right? So the government tries to create a tax incentive to keep money in the market, to let it grow, and to not take small poker bets. If you do, you will get a higher gain on that. If you wait and go longer than a year, you actually get a reduced cap gains rate. So it's closer to 15 to 20%, depending on your income.
Yeah, very cool. And something that, when we're thinking about long-term investing, I feel like something that comes up. I know this, comes up for me. I know you and I both are reading a lot of news all the time, and it's like very easy to get distracted. And so we all think of ourselves as like expert long-term investors. I buy this, I'm going to hold it until, if like retirement, or I'm going to hold it until, X date. Like we have a time frame that's very far off, and we get really disconnected from it. And something that happens often is, you get gut punched, or, something happens in the market, or you read a headline and, you're reacting, and you're like, your philosophy can change. So what do you feel like on a human emotion level happens to us when we get gut punched, and why is that the right or the wrong way to do? So if you could talk about that.
Yeah, definitely. So really what you're referring to is kind of conceptualizing, is reality changing, right? So when we make a long-term investment, especially when we're here, we have an invest committee, we have a process, we have rules of why we do and do not buy things. And those rules can seem like kind of arcane, but what we're trying to do is take the human emotion out of it. So when we buy an investment, we're thinking with every one of these investments, do I want to hold this for the next 5, 10, 20 years? And at the time when we buy it, the answer is typically yes, right? But we can't just sit there and say, okay, JP, Andrew, and Brendan made an investment decision in 2025 and then not ever look at it again, right? So as active managers, we look at this every month. We review new earnings data, right? So we're a little bit more proactive. However, it's very human to see a quick move in a stock or a quick move in the market. If you turn on CNBC and there's a down day, there's this big red headline, market crash alert. It's red, right? It's trying to elicit a response, and the market does that, right? And now people on Wall Street don't get scared by CNBC headlines, but normal people will. And so we get very common questions when there's some kind of froth in the market of, well, what do we need to do? What action do I need to take? And if you look at the data, if you do any kind of math, I'm actually writing a piece for a newsletter about this. The answer is you really shouldn't do anything, right? The preparation before you get invested or while you're investing and getting new cash flows will basically save you all the headache of any fear that you might react to.
Yeah, totally. And that kind of, it's almost like consumer sentiment rather than like the headlines. I mean, we're very into the headlines, and, a lot of people, I mean, not that we react to them, but, we're always looking at the headlines. And if you're an avid news watcher, you're definitely watching the headlines. But what really does change is consumer sentiment. And I feel like that's the time where I really start to, hear in the conversations you're having, the conversations, the calls that we're on, I start to hear people, talking about it more mainstream, or, just people that I talk to in life, you hear the consumer sentiment changing. And,
it's really interesting because I often find that when we're most worried about an idea or a topic or a theme, the public's not there yet, right? Because we're just doing two different types of research, right? By the time it makes a Wall Street Journal headline, by the time it shows up on CNBC, there's usually a glide path to get there. And so, great example would be when we bought bonds, rates shot up from 0% to about 5%. And everyone was like, oh, well, now you go to bonds and pick it up. But the story wasn't really complete yet, right? Because, okay, it shoots up to 5%, but then do we go into the greatest recession of all time? Do we then have to drop it back down to zero? We saw a taper tantrum in 2018.
Mm-hmm.
And so when we think about the history and the context, we still have to keep our heads on us and say, okay, what is the time to make a structural change, right?
Yeah.
And also, sometimes things really do change. So, we held a company where the CEO or the CFO got fired and they had to restate their books. We don't want to be a part of that, but that's something that the market couldn't have known until it hit the news.
Yeah.
So then you need to make a reaction potentially. So it's not just every input that comes in every time there's bad news, we just ignore it. That would be silly. But a lot of times if someone on TV is getting paid to come on and say you should be scared, maybe you should, but you probably shouldn't, right?
Yeah.
Because especially if you work with a manager, the assumption is they're doing that work for you. And then you can come to them, talk about what they're doing, have an honest conversation, and feel a little bit better about it.
Yeah, absolutely. And do you want to talk any more about the research that you did and kind of your findings? You said you shouldn't do anything. You speak more to that.
Yeah, definitely. One very common thing you'll hear in this business, and also just talking with anyone out in the world, is I think the market's a little hot. We're at all-time highs. Is now a good time to buy? So I did an analysis of just okay, well, let's say I basically went back to 2010, beginning of 2010, looked at weekly S&P 500 data, just kind of the broad US index. I said, what if I put in $1,000 every single time there was a new high point in the S&P over that time period? And, there's about 194 of them, right, on a weekly scale. So, about 25% of the time, there was a new all-time high, which is great. That means the stock market's getting bigger. So you put in $1,000, pay $1,000, pay $1,000. Well, I did that versus, well, what if I just was agnostic and I said, I have a certain amount of money. I want to just invest that every month or every week, no matter what. It's very similar to a 401k.
Yeah.
The difference in total return was 4%.
Yeah.
Right. And so you would think okay, well, even if I only bought at the absolute highest price, I bought the market top, you're rewarded for holding over the long term. Now, there could be some other analysis of, maybe if I compress the timelines, but who cares? If you're investing for your retirement and you're my age, right, or your age, or even Brandon's age, when you think more than 5 years out, you almost always get rewarded by time in the market, right? And then, there's the other piece too, which is, okay, well, what if I took all that principal, it's about $194,000, and I just put it in, right? I sold my house in 2010. I got out of the city. I used to work on Wall Street. I got fired. I sold my house, took the equity, put it back in the market, and then moved, to Atlanta, Georgia. And you would have done fabulously well, right? So just putting all of that money in there, really being agnostic, meaning I'm never adding another dime to this, you would have had about double the money.
Yeah.
Right. And so the two strategies that outperformed were the least active, but then the one active, which is very counterintuitive. I only buy at high prices. You also still got rewarded. So ultimately the theme there is put money in, try to plan your life around that investment so that the investments can just do their thing.
Yeah.
Let it grow. The old saying is time in the market rather than timing the market. And that's true. There's not a single study you could ever do with really any asset class that would show that that's not the case, unless you bought all your money in Japan in the 80s and then never moved out of it. But you can use your brain on that.
Yeah, absolutely. Yeah, and that's kind of the thing that evokes for me is lots of times we talk about clients will deposit a lump sum or they have recurring transactions, and what do? We dollar cost average into the strategy.
Totally.
So,
we usually put about 50% in, and then we dollar cost average the rest because in the short term, there could be some price action. Right now is a great time where, if you look at 100 different charts, you're going to see ones that go up, down, and sideways. And, there isn't really a strong theme of where it's going. So we'll just put some money in. We'll add to it every month. Eventually it'll all be invested. And then we get right back to our long-term view of let the money grow and let it do its thing.
Yeah. Could you talk a little bit about just for everyone listening, the what dollar cost averaging does, the effectiveness of doing that?
Yeah, definitely. So dollar cost averaging, very simply, is adding on a periodic schedule money into the market, right? So the traditional idea of that is the 401k. Every 2 weeks, you say, I want to contribute X dollars, and it just goes and buys whatever the strategy is, right? And what it does is actually works up your cost basis, right?
Yeah.
So if you have something at 100, then at 120, your new average is 110.
Yeah.
And it just incrementally increases the cost of your product. And so on the way down, you're lowering that cost basis. And on the way up,
Yeah.
you're buying that cost basis, right? So it really just smooths out the curve and then allows for the natural compounded interest to add on top of it.
Yeah. And I think something else that's, relevant is, we talk about long-term investing and the long-term view of things. And then so often, you and I, when we're, doing something for investment committee or when we're just looking, we're pulling up a stock and the first thing we click on is year to date. We look at the year to date.
Yeah.
And it's like, why do we look at the year to date sometimes? It's like, I almost look at it and it's like, sometimes it's a scary year to date and I go click 5 year instantly. And then I'm like, okay. It's all good. So I'll be on a chart, I'll have it on year to date. I'll be like, that looks scary. And I'll click 5 year and then I see a much smoother curve. So why do we even look at that?
Yeah, I think humans naturally look at things in years, right? It's like we have birthdays to celebrate 1 year of life. And we very like to segment things. It's very clean on the organization. And you have to be careful about doing that because let's say with the last 2 years in the stock market, the stock market was up anywhere from 20 to 27%, depending on the index, 2 years in a row.
Yeah.
Right. So the growth of that is incredible. So even if we had a pullback, 2% or 5%, or we had a down year, we had a 10% down year, we're still up net positive over that time, right? And so that's the point is the further you zoom out, the more you realize, oh, I am being rewarded if I can just hold on.
Yeah,
right.
Absolutely.
And then, a lot of can I hold on goes into planning. And I say it every single video. Do I have enough cash? Have I paid down my debts? How is cash flow feeling for me, right? Can I just not have to dip into things because I have enough coming in, right? Maybe I pull back on my savings because I need that to do X, Y, Z, but can I set up a plan for myself to where I just let those things happen in the market? And the best thing we ever hear from clients is, I feel like I'm in a really good place. I don't really have to worry about that.
Yeah.
I just kind of let it go.
Yeah.
That is when we've reached a really good point because, that means that, A, they trust us, which is nice, but also they're doing the best thing for them, which is not trying to mess with their investments.
Yeah, absolutely. Yeah. And I feel that planning point is super important because I feel like so often we bifurcate the two things and there's the market and then there's my financial plan. And,
right.
And they are separate, but the idea that when you're planning your financial plan, it's so easy to look years and years and years in the future.
Totally.
And it's just right there. And it's just oh, everything makes sense. And and then the instant that we start talking about the markets, our brain switches and we're like, no, I can't think past tomorrow.
It's like, the market's doing terribly. Okay, well, this says you're going to live to be 94 and you're 60. So, maybe there's some room in there to be right and be wrong.
Yeah, totally. Right? Totally. Well, it was good talking this morning.
Yeah, thanks for coming on and interviewing me. I appreciate it.
Absolutely.
Thank you guys for doing a good video.